Good day, my name is Dean Crocker. I'm a senior equity analyst for the PSG Wealth team, and today I'll be talking through our latest EIA completed on Sasol. So just before I get into the crux of the slides, there's a few key takeaways I wish to leave with you following the presentation. In terms of their guidance, it did seem a bit softer than expectation. The group does seem relatively cheap right now. However, there is some looming ESG risk, which has been highlighted through various presentations, as well as in the Capital Markets Day. So just in terms of the 5 or 6 key takeaways, we are upgrading our recommendation from an underweight to a neutral position. And the reason we're doing so is at current levels, the group does seem to offer value, particularly traded on an EV/EBITDA of 3.8 times, which is respectively a 31.8% discount to its 5-year average. The group has done a lot of work of improving their balance sheet, particularly through the asset divestitures. This has also allowed them to improve their net debt position, which has improved significantly and is below the $6 billion mark. I have noted that just as a point because it does filter into some of the presentations a bit later. There is a bit of concentration risk in terms of the debt sitting in the group corporate center, which does concern us slightly. The group does also offer an attractive rand and oil hedge, largely due to a strong correlation with the rand oil price. And the earnings volatility has been mitigated to an extent through the zero-cost collar which they entered in the fuels business. There's also a stronger positive crude outlook with the revamping of economies as the various lockdown initiatives start to dwindle. So let's just get into the event. So this was the full year 21 results. The results were buoyant on the back of stronger Brent crude oil prices, as well as the chemical prices. It was partially offset by a stronger rand, but not to a large extent. Whilst the remeasurement expenses fell by 382% to 23 billion. It is worth noting that a lot of the expenses did include once-off events. In this event, there was an impairment of the wax, the chlor-alkali, and the PVC units. Thus, the various periods, particularly the last 2 full-year results, make it quite difficult to do a line-for-line comparison, which is why they have declared a core headline earnings, which is up 84%. In terms of adjusted EBITDA, it did see a nice improvement of 38%, resulting in a margin improvement up to 24%. And despite the group receiving relatively stronger cash flows, reducing their net debt and a stronger balance sheet, they have withheld declaring any dividends until future reference. There is a few trigger points in which they will declare a dividend. I'll touch on that in the final slide. So in terms of the impact, on the date of the release, the market reacted negatively. The share price closed 5% lower. Also, JSE was only 0.41% lower. However, since the beginning of the year, Sasol has been a standout performer, outperforming the benchmark by 44.1%. That has also a strong correlation with the rand oil prices as the economy started to reopen post-COVID lockdowns. Since February 2020, which was our last underweight recommendation, Sasol has declined by 18.42%. In terms of the assessment, management has done a lot of work on trying to right-size and refocus the existing business. This is ready for future growth. There is expected to be a few once-off events or once-off costs in this next period relating to some of the employees. There's some retrenchments that have taken place. The group has, however, strengthened their balance sheet through a lot of the asset divestitures, and it also has allowed them to reduce their capex spending requirements. In terms of the net debt to EBITDA, this has improved from 4.3 times to 1.5 times, which is a key metric for the dividend or future dividends. However, this does not account for the trade and other payables, which is sitting on balance sheet, which is roughly 22.6 billion. That is one item that does concern us, and we will be watching closely. In terms of the debt or the existing debt, which is below $6 billion, most of it is concentrated in the corporate center, which has effectively saturated itself. Now, that implies that the group needs to implement a lot of cross-country transfer pricing policies in order to remove or bring cash back to the corporate center to pay off that debt, which does just add a bit of risk to this balance sheet. And it is a largely US dollar denominated debt as well. In terms of the earnings predictability, so there was a zero-cost collar implemented. This has allowed to reduce their cash flow volatility. It was roughly only about 30% of the group revenue, but it is something. The floor price at $60 relative to the cap price of $71. That is relative to right now, so it has capped the upside performance for this period, but added an element or reduced an element of risk on the group's earnings. The earnings are, however, expected to improve, benefiting from a lot of the cost-saving initiatives that have been implemented. There's also a normalization of a lot of the businesses, particularly in the energy business. And a lot of the once-off events we do not expect to see reoccurring. There might be a few in terms of the cost-saving initiatives through personnel restructurings. However, those large once-off impairments should no longer really occur. In terms of the dividend, so this is key to the board of Sasol. It's something that they are really putting a lot of focus on. It is, however, contingent on a final say by the Sasol's board. However, they have said that the 2 points that need to be achieved is they need to maintain a net debt to EBITDA of below 1.5 times, which they have achieved, and an absolute debt level of below 5 billion, which they're working towards, that they expect to achieve before the year end. On the achievement of those two inflection points, it's then at the board's discretion to determine whether they want to release or declare a dividend in the future periods. Just in terms of the hedging, so this was just a nice graph to show you more or less what has occurred over the past few years. This is where the floor and cap is. Now this is for a period of 12 months. I think the expectation is that once those 12 months are over, they may re-enter into hedging, alternatively depending on where the crude oil price is, which is currently roughly around $78, which means they are missing a bit on the upside. They might renegotiate these or just start opening to free contracts. And one of the key underlying principles and fundamentals to our recommendation upgrade from an underweight to a neutral is just their strong correlation to the Rand oil price. It offers a Rand as well as an oil hedge, which, given that there is quite a bit of expectation for the crude oil price to continue increasing or maintain at the current levels, does offer a nice potential hedge for underlying investors. So if you'd like to place a trade, you're welcome to speak to either your financial advisor. Alternatively, the trading desk is more than willing to assist. Please take note of the disclaimer and have a great day further.